Good afternoon, everyone, and thank you for joining our webinar today. It's my goal to make this worth your 2 hours. And Brad Borden, we are fortunate, very fortunate, to have Brad Borden joining us today. And Brad is going to be adding some color and enlightenment to some of my slides and some of the topics that I'm going to speak about, and also going to be presenting an entire hour of the presentation on ethics. So the first portion of the presentation is on partnerships and special topics in a 1031. This webinar is for people that have basic 1031 knowledge. Okay, those of you that don't know me, I'm a senior VP with asset preservation, and asset preservation is a nationwide qualified intermediary. We facilitate 1031 exchanges. We facilitate all forms of 1031 exchange. We handle reverse exchanges, improvement exchanges, and delayed exchanges. We do not handle anything that is not considered a safe harbor exchange. So I work a lot with Brad, I can just tell you that, because there's many times when my clients need legal or tax advice, which I cannot provide. Only Brad can provide that, or an attorney or CPA. So even though there's an ESQ after my name, and yes, I'm a lawyer, when I function as a qualified intermediary, I cannot give tax or legal advice. So that's the distinction. So between the company and I, we have more than 25 years combined 1031 experience, and I have many years more than that legal experience, which and sometimes it sounds good, and sometimes I'm not sure I want to be so senior. Let's go on now to the actual presentation. Here is the outline of what we are going to cover. We are going to cover partnership issues at length. And what I'm going to do is I'm going to cover partnership issues, drops and swaps, the holding period. Then Brad is going to add some insight to those concepts, and then I will continue on with partnership installment notes. Also, we are going to discuss today special entity issues, seller financing, partial exchanges. Sometimes people have a partial exchange, don't even realize they have a partial exchange. The G6 restrictions, and then something that's brand new just this week, real property defined. We're getting some proposed regulations on what is the definition of real property. So I will give you just a slide or two on that subject, because the regs are only proposed and we don't have a lot of definition at this point. Closing issues with 1031 exchanges, particularly exchange expenses. I'm going to address that issue. It's always a hurdle for our clients to understand what is boot and what is not boot when they're closing a 1031. Split treatment transactions, which involve 1031 and Section 121. The related party guidelines and what is a related party transaction. The extensions we were provided under Notice 2020-23, which are almost moot at this time, but there's a couple of points I want to make about them that are still relevant. And then finally, FERPTA, if you have a foreign seller. So that's my content. And then Brad is going to discuss ethics and a 1031, which is a really, really interesting part of this, and probably the most interesting part of this presentation. Okay, so in a 1031, the basic requirement is we must be buying and selling real property we've held for investment or use in a trade or business. So with partnerships, if we have a partnership or a multi-member LLC owning the building that is being sold, the partnership or the LLC is the tax owner that owns the real estate. Okay, the individual partners, even though we may not realize it, the individual partners own personal property interests. And when I refer to partnership / LLC, I'm going to use the words interchangeably, and a multi-member LLC has members, a partnership has partners, but again, they are the same in the context of a 1031 in that whether you own membership interest or partnership interest, they are personal property, and the partnership or the LLC owns the real estate. Now, no, I did not refer to single-member disregarded LLCs. When I'm referring to LLCs in this context, I'm referring to multi-member LLCs that are recognized as a taxpayer, so they file tax returns. What happens with partnerships? Well, if a partnership or an LLC is selling property, let's say, for $9 million, and they want a 1031, and the partnership is staying intact, nobody's coming or going, and the partnership is selling and buying, there's no issue. We've got a 1031 exchange for a partnership. Same thing with an LLC. Same thing with any other entity, corporation, trust, what have you. The issue comes up with partnerships, and I'm going to explain a couple different scenarios that come up with partnerships. Which scenario you are faced with will dictate the best solution for you. So one thing I don't want you to walk away from, I don't want you to walk away from this saying, okay, Pamela told me if I have a partnership, then I should do this, because it's not even close to that. Every situation needs to be analyzed on its own. The first and most common situation with partnerships or LLCs is that the partnership does not want to stay together and do a 1031. In fact, each of the partners want to do their own 1031. So let's say in my example here, I have 3 partners and they all want a 1031, but they want to go their own way in their 1031. So the partnership owns a capital asset, but not only do the partnerships only own personal property, but under the revenue procedure. But in addition to the fact that they are personal property, partnership interests are specifically excluded from Section 1031 under the regulations. So even if they were somehow real property, it's not going to qualify. So if a partner wants to exchange, they must first convert their interest into a capital asset, so a piece of real property. So the 2 traditional ways that is done is a drop and swap. That's the term of art in the industry, so to speak. So let's first focus on the drop and swap. A drop and swap involves the liquidation of a partnership interest by distributing the interest in the property owned. What am I saying? The partnership will execute a deed. In this case, the deed would be a deed to 3 former partners pro rata, so 1/3 each if they're 1/3, and each partner would acquire a 1/3 direct interest in the real property. Now, if these partners are individuals, in most cases, each one is going to form a single member disregarded LLC in order to take title in that LLC and not have personal liability for what goes on with the property. So a drop down will be completed via deed. Yes, it's a recorded instrument. Then hopefully the former partners will enter into a tenant in common agreement. Hopefully you've spoken to your CPA about this, because after 2008, you are required to disclose on the tax return of the partnership whether there has been any distribution of partnership interests in the last tax year. Likely, the partnership will then liquidate. Now, you also have to be careful. If the partnership owns more than one property, the drop-down will apply to all of them. And if that's not the desired intent, then you must restructure ownership of likely the other properties before you do the drop-down, so your ownership remains as you wanted to with each of the properties. But in our example, let's just presume there's one property here. Okay, so we've done the drop down. So now we have tenants in common on the deed. Does that in itself create tenants in common? No, you need to walk and talk as TICs. So what else should you be doing? You should be changing your bank accounts, your insurance policies, the way you do business, the way you sign all legal documents. Everything should be changed to reflect that ownership is now as tenants in common. What is the biggest hurdle to a drop and swap? Well, the biggest hurdle to a drop and swap is actually 2. First, people are unaware of the issues that I'm about to discuss, which increase the risk if you're doing a drop down close to closing. And the second is there's a lender involved, and they may want to do the drop down, but the drop down would violate a loan covenant, and that would not be good news. And either they can't, or the lender does not want to consent to the drop down. So that is those are the practical issues with the drop down. The second practical issue is timing, and we're going to address that now, and I'll come back to the second issue on that slide, the swap and drop option. So remember, in a 1031, you have to hold property for investment purposes. If the drop occurs too close in time to the exchange, there can be a question as to whether the relinquished property was held for investment. So we have a holding time period that is one of the factors the IRS examines, or the state, if they look and audit the transaction. The conservative view is 2 years without any resale activity, and the liberal is 1 year. When you do a drop down, you change the tax ownership. So technically speaking, this means that all of a sudden, while we may have owned this property in the partnership for 20 years, now guess what, everyone? We own only for a short time, possibly, because we've converted to tenant in common, and now we may sell the property shortly after that. So we have to talk to our tax advisors, our CPA, our lawyers, if we have a short term or a short time period between the drop and any sale of the property, to determine what is the risk and will we accept the risk. And Brad is going to enlighten there. But as far as I'm concerned with clients, drop downs that are done anytime within a year of a sale are at risk, and the 2 years is better. You really want no resale activity during that year, if that's the time period you're holding on to for establishing held for investment. And what is resale activity? Listing the property for sale is a resale activity. Now, that's the ideal world. Most clients cannot satisfy that year time period, or many cannot. So they're going to accept some degree of risk. And here are degrees of where your risk gets higher and higher and lower. Having at least a year, as I said, helps enormously. If you don't have a year, separating the drop down and the actual sale of the property into 2 different tax years can be helpful. Definitely helpful is doing the drop down before the contract for sale is signed, because when you sign a contract for sale, you've obviously had a situation where there is resale intent already apparent. And so the longer the better. Degrees of risk increase when you are doing the drop down and you have already signed a contract. So you may be on the verge of actually closing. Now, that said, I have a very significant number of clients that do drop downs right before closing, after the contract's signed, and they simply get their legal and tax advice because that's the best we can do. There is a case here mentioned, it's the court holdings case, and I'm going to mention that when I get to the partnership installment note. I think it's a little more relevant to that situation. So if you want no risk at all, and you are on the verge, maybe you've even signed a contract to sell, then the option is the swap and drop. What is that? That is that you first exchange and later on you drop down. So how would that look? It would be the partnership with the 3 brothers staying intact, not only signing the contract, but closing. The $9 million coming into the exchange, and the brothers using $9 million, or the partnership, I should say, $9 million to buy replacement property. And holding that replacement property for how long? Well, you probably know that answer, preferably 2 years. Brad will probably be more liberal than that by a lot. Maybe a year, maybe a couple of months, but at least a year would be my recommendation. And then what? You drop down a 1 property or pro rata share of partnership assets to each partner. Now, what are the hurdles here? First of all, distributions of partnership assets are tax exempt as long as it's pro rata under the code. You can't do this with a C Corp or an S Corp or anything like that. You just cannot. It's not permitted. But the magic here is that it's got to be pro rata. So this means that that each party must, if they're 1/3, they must be getting 1/3 of the assets. So the practical issue with drop downs, if you are swapping and dropping, is let's say you bought multiple assets and you bought $9 million, each one is $3 million, and then you drop down one property to each brother. Well, if they've all stayed the same in value, great. But if one's gone to 10, one's gone to 2, and one's stayed at 3, and you drop down, it's no longer a pro rata distribution of partnership interest, and likely the result of that is there can be some kind of tax due by somebody, and that's when I again send you to your CPA and or Brad. The other practical issue with doing the exchange and then the drop in the 1031 is that, remember, you have one partnership doing the exchange in the swap and drop scenario, not 3 brothers. This means they get one set of identification privileges, which means they either have to identify 3 properties, or if they identify more than 3, they have to ensure that the total value does not exceed 2 times what they sold. So if the brothers wanted to identify one property for each brother and one backup for each brother, that would be 6, and they would have to make sure that the aggregate value did not exceed 2 times their $9 million or $18 million. So it's, when everybody's trying to identify different property, can be a problem. It's not a problem where the partnership intends to buy just one asset and is going to divvy up that one asset down the road. So there are two, so you don't have to worry in that circumstance. It's a circumstance, the practical issue arises only when everybody wants separate properties to identify, so that they know what they're going to be getting at the end of the day, so to speak. Okay, so those are the 2 scenarios that we have with partnerships where everyone wants to 1031 separately. Now, if somebody wants to liquidate, that's a whole different matter, and we're going to talk about that when I get to the pen.
The thing that we see is maybe sloppiness is more of a problem than the time period, right? If you do a distribution 2 years before the exchange and you haven't formed a TIC when you do the drop first, then that's not helpful. And if you do the drop immediately before, if you do the drop immediately before, it's hard to form the TIC, right? To have a TIC, you have to have separate management provisions. You have to have a TIC agreement. The members have to treat the ownership as a TIC. There has to be proportionate sharing of profits or revenue and expenses. That's hard to do if you're doing the drop a day before or at closing. So I think that's as much a concern as the timing period. If you're going to do a drop, you have to make sure it's TIC ownership. If it's not TIC ownership, it's going to be a partnership and you haven't solved any problems, right?
Right. So formalities, try to look out for all the formalities. Right.
And it's not just a matter of like creating documents. There has to be accounting formalities, right? The members actually have to be involved in management. So if you're going from something where there's a GP that was managing the property, you go into a TIC.
No more.
Yeah. So these are, I think, and getting that done immediately before closing is very challenging, very hard to do. So
and how you're going to change your insurance policies, your bank accounts, all the documents. And the cases, there have been cases, both federal and state level, where they look at that and they say, you didn't do anything to show you were TICs. I'm not sure that all those go to a ruling, they mainly settle, but you would rather not have that issue arise. So I want to also make very clear that since I started doing this in 2004 and before, and to date, we have no clarity on this issue that comes up every single day of my qualified intermediary experience. We have some case law on the federal level that appears to be tax friendly, but it's not directly on point. It's not in our jurisdiction. So there is simply no clarification. And I'm hoping that we can get that clarification soon, some kind of certainty as to when a drop down will be recognized. And I don't know if anybody saw that article last week. I don't know if anybody saw the article. I don't even know where it was, but there was an article that New York State was going to start increasing the audits in general, including of 1031s, and that they weren't going to be bound by the federal conclusions. So who knows what that means, but it sounds like we're going to have more audits. Okay, now let me talk about a separate issue with partnerships. Partnerships where, not where everybody wants to do a 1031 on their own, but where you've got a partnership and you've got partners that want to stay together in 1031, but you've got some that want to liquidate. So first of all, let's take my $9 million example. Let's say they're selling for 9 and one of the brothers wants to liquidate. Well, if the partnership has $3 million someplace else they can use to buy out liquidating partner and brother, that's the easiest way to proceed by far. You just do that, you use other funds, the $9 million comes in, you use it for your 1031. However, most of the time, my clients don't have other cash available. Even my big funds, because although they're going to be bringing in new partners before they buy the replacement property, and they will, as a result, increase their equity, they don't necessarily have it there today in order to buy out a liquidating partner. So a couple of years ago, we developed something called the Partnership Installment Note with the enormous direction of Lou Weller, who is a tax guru in this area. And what this does is it allows the partnership to effectively do a partial exchange, not using that $3 million for replacement property, but transferring liability for the $3 million from the partnership to the exiting partner. And to understand what I just said, you have to recognize something. If I do a 1031 and I sell for $9 million, no debt on the property, and I use $3 million to buy out a redeem and exiting partner, that $3 million is taxable boot to the partnership, and every partner owes their tax on it pro rata. Just because I used it to buy out the exiting partner does not mean that just the exiting partner is liable for the tax. So that's not the desired outcome. When money is used from proceeds by a partnership to liquidate exiting partners, they want the tax to be owning, the liability for that to be owning rest on the exiting partner or partners. A PIN accomplishes this. So what it does is this. At closing, the buyer would pay in $9 million. $6 million would go into a 1031 account with asset preservation for the partnership. $3 million would go into a commercial bank account owned by asset preservation. Simultaneously, with receipt of that money, which is now in our account but is really partnership money, API issues a note to the partnership for $3 million, the amount we were holding. The note, by its terms, must stand up to the test of what is an installment note under Section 453. Why? Because under Section 453, if something is an installment note, obligation is an installment note, then that means that tax liability is not due when the note is received by the recipient. It is only due from the person or entity that receives payments under the note. So what happens is the partnership receives a note for $3 million and immediately turns around and transfers the note to the exiting partner or partners. So before the first payment is due, which is generally 2 weeks after closing, the exiting partner now owns the note, and that payment is made to the exiting partner. The balance of the note has to be due and payable in the next tax year, and that balance has to have some economic substance to stand up to the test of what is a Section 453 installment note. Now, this particular tool is not covered by a safe harbor. So whenever we are using a PIN, we require a tax attorney be involved. And Brad has been that tax attorney on a number of occasions for our clients. I want to make one more point, and then I want to see if Brad has any comments about this. Now, when you want to use a PIN, one thing I'm going to assess before we get too far along is whether this is going to result in a perfect exchange for you. So in my example, we had a $9 million sale and there was no mortgage debt on the property. That means the partnership uses $3 million to buy out liquidating partner, uses $6 million in their exchange, and does a full exchange for $6 million and ends up knowing no tax. But what if I change the facts? What if I tell you that there was $5 million of debt on the property and $4 million only of equity? And if we use $3 million of equity to buy out an exiting partner, or even some significant part of that, that means we're only going to have $1 million left in our 1031 exchange account, and we've got to meet the exchange equation, which means we've got to also replace $6 million of debt, with either new debt on the replacement property of 6 million or cash from another source. So if we are heavy on leverage, it's going to deplete our equity. And unless we can raise other equity between closing of the sale and closing of the replacement property purchase, we may not be able to meet our exchange equation. I have not seen clients fail for that reason, maybe because I don't let them out of the gate if they have that problem. But those that are short a little bit on equity have been able to raise equity from other sources. And what I'm basically saying here is that the lenders aren't going to give you a loan of 5 or 6 million with 1 million of equity, most likely, especially today. And so how are you going to meet your exchange equation unless you've got other equity to put into the deal? So that's my last point on PINs. Brad?
Yeah, I mean, there's not a whole lot left to add. I mean, I guess one thing to think about is the note is being issued by the QI company. The QI company receives proceeds. They're going to include the exchange proceeds and the proceeds that the QI is basically going to use to pay off the note. But the proceeds used to pay off the note don't go into the exchange account.
Correct.
They become part of the QI's general funds, and the note is the QI is liable for the note. So that's
correct.
Yeah, that's one thing to think of. Another thing to think about is if the property is real property, is 1250 gain, that's going to be recognized. That gain goes out with the note. So pay attention to that. Do that accounting. Now, the person who receives the note, if the person is being liquidated, the person will take a basis in the note equal to the outside basis. So there may be some gain that's actually eliminated through this process. But I do think the point is that there's some complicated accounting that goes on with the note. And so,
got to see your CPA absolutely on this before you embark down this road. I also want to, sometimes the question comes up is, well, why can't we just get the note from the buyer? Why do we get a note from API for this 3 million? Well, you could, but most people would much rather rely on API that's wholly owned by a 125-year-old publicly traded company than their buyer to pay the note. So, you know, that's the distinction there. Okay, I'm going to move along. Sorry, Brad.
Did you say to get the installment sale treatment, at least one payment on the note has to be made in the subsequent tax year?
Yes, I did mention that. And that's where our tax attorneys come in telling the client what portion of the note must be due and payable next year to stand up to the test of an installment note. We've seen as high as 95% paid out right away and 5% in the next tax year, but obviously it's not a percentage issue. Depending, you know, a 5% of 5 million is going to be a lot less than 5% of 50 million. So it's really about the dollars involved. So the next issue I want to address in a 1031 is the fact that the same tax owner must buy and sell the relinquished and the replacement property. So one of the first things I do when we set up an exchange or when you call me is to identify who is the tax owner. Now, many times that's the person or entity on the deed, but not always. Sometimes, and many times actually, we have an LLC on the deed, on the sale of the relinquished property. So I have to ask a lot of questions to find out if that LLC is a recognized taxpayer or a disregarded entity. Most of the time, if it's a single member LLC, it's disregarded, which means that the LLC does not file tax returns. All profit and loss flow through to the individual or the entity that's the sole member. There are exceptions to that, and I can't make that determination. So I need such minimal information or documentation to set up an exchange, but if I get a contract and there's an LLC, I'm going to be asking a lot of questions till I'm satisfied who is the tax owner. So corporation sells, corporation buys, partnership sells, partnership buys. Let's highlight some issues that arise. Wife relinquishes, wife acquires. Wife always wants to put her husband on the replacement property deed because wives are very generous. So what happens then? It's usually not good. Let's take an example. Wife sells for $1 million, all equity, no debt. She buys for $1 million, puts her husband on title. Disaster occurs because that's an immediate gift to husband of 50% of the replacement property, and that means it was not held for investment, and that means at best she has just protected only $500,000, which probably doesn't do her much, if any, good, depending on her adjusted basis and what she sold, and was clearly not the intent. Second issue, if it's a single member disregarded LLC, Smith LLC is a single member disregarded LLC owned by John Smith. John can buy the replacement property in a brand new single member disregarded LLC, of which he is the sole member, or in Smith LLC, or in his individual name, or even in a grantor trust, a revocable trust of which he is the grantor. So there are options. Why are there options there? Because in all those scenarios I just described, John Smith is the tax owner and will be filing the tax returns. So it's critical who files the tax returns. If I have a discrepancy, let's say I've got husband and wife on the deed, and there's been partnership returns that have been filed for 10 years. Who's our tax owner? Now we have a conflict. The client has to get some legal advice to determine who has had the benefits and burdens of ownership all of these years. And that, will depend facts and circumstances. Who has been acting like the owner? Who's been paying? Who's got the bank account? Who's been assigning documents? And it happens more with individuals that are not married than husband and wife, that this kind of circumstance arises, where they bought as tenants in common virtually, and then they filed partnership returns all these years. So there's confusion as to who has tax ownership. And we cannot begin the exchange, because if we name the wrong tax owner in the exchange documents, and it's wrong, the exchange will on it. So here's a couple of exceptions to the rule. An LLC with two members, the third prong, will be considered a single member LLC, which is, there's very few cases where you have a two-member LLC that is disregarded, okay? But here's one. If the sole role of the other member is to prevent the other member from placing the LLC into bankruptcy, and the limited role member has no interest in profits or losses nor any managing rights. So you can't automatically assume, just because you got two members, it's a recognized or regarded LLC. You got to ask a little more. Here's another situation where it's disregarded. What if an LLC has two members, both of which are LLCs themselves, and both of which are disregarded, and they are disregarded to John Smith? Even those two LLCs as members, you still have one tax owner. So you have to be looking beyond just the face of the documents. Seller financing in a 1031. So why am I mentioning this now? First of all, it is a little more complicated than the garden variety 1031 information, but because in our current times there's an increase of seller financing, because the buyers, we signed a contract before all this COVID stuff. Now the buyers are either going south, renegotiating the price, or telling you we can't satisfy our financing contingencies, so we're gonna end the contract, terminate the contract. So unless seller, you can give the financing. So my clients are calling saying, can I provide the financing? Well, it's usually a disaster to your 1031. Here's why. Let's say we've got a $10 million sale, and let's say our buyer can come up with $2 million. And they want us to take an $8 million note back, and the seller's willing. What happens in the exchange? If we sell for $10 million, $8 million goes to the seller in the form of a note, and only $2 million into the account. Let's say there was no mortgage debt on the sale, on the $10 million sale. That means we only can include $2 million in our 1031. The likelihood is that's not going to give us any benefit at all, and I'm going to talk about how you evaluate in a 1031 whether a partial exchange gives benefit or not in a moment. So that doesn't work too well. What can be done? Well, there are some workarounds, but in most cases the seller can't perform the workarounds. If the note is made payable to the intermediary, here are the workarounds. Not assigned to the intermediary, but the buyer makes the $8 million note payable directly to the intermediary. It can be placed in the 1031 account along with the $2 million. Okay, then you have to go through one of the four options to use that note somehow before you close on replacement property. The first option is the seller can purchase all or part of the note with separate funds prior to purchasing the replacement property. So if they have $8 million sitting around, man, it's a very wealthy seller. They can buy the note goes back to the seller, $8 million comes back into the 1031 account. We use it with the $2 million to buy replacement property, perfect exchange. When the seller gets payments under the note from the buyer, they don't owe any tax on the installment basis or otherwise, because guess what? It's deferred because they included it in the exchange. So that's option one. Option two, if you could have a third party can buy the note. So it doesn't have to be seller providing the 8 million, anybody. But again, that's a difficult practical issue to overcome. The third option, never seen this happen in all of my years. The note may be used as payment for the purchase of replacement property. So if you by chance had Bill Gates on the note, they're the buyer. Bill Gates couldn't come up with $8 million, we're in trouble. But in any event, maybe the buyer, the seller of your replacement property will accept that note as part of the purchase of the replacement property. Not going to happen. So number four, what if it's a short-term note? That works. And that I have seen happen more than any of the other scenarios. The note's made payable to API. It's 3 months into your 180 days. The buyer pays it off. That 8 million comes into the 1031 account and is used to buy replacement property, and you have a perfect exchange. Bottom line, if you have not already agreed to seller financing in your contract, do not. Just do not, because it's very troublesome and it will taint your 1031. And probably not worth selling the property unless you can 1031 if you've got significant gain. It may be wiser just to lower the price a little bit and get another buyer involved. All right, so on a partial exchange, which is like the $10 million situation where I'm not getting the full 10 million into replacement property. Let's change the facts. Maybe it's only a $5 million note and 5 million of cash coming in on day one. And it's a long-term note and we don't want to make it payable to API because we don't have 5 million to buy it or any of those other solutions. So we're going to take the $5 million note back as boot. And by the way, this is with a note. Anytime, let's say you're going to closing and you want to put 2 million in your pocket of the $10 million sale, it's boot. That's a partial exchange. Partial exchanges happen by accident and by design. By accident, you didn't buy all your replacement property. We're left with value in your 1031 account. At the end of the 180, you're going to pay tax on that. By design is you tell me up front, Pamela, I'm selling for 10 million. I want to put 2 million in my pocket and 8 million to go into the exchange, and I'm going to pay tax on that 2 million. So when someone tells me up front, I want to do a partial exchange, we have to make sure that they don't march down this road and pay our fee and do the exchange and identify and all of the brain damage that goes along with the 1031 and find out they got no benefit. So how does one analyze that? Well, I'm going to give you a high-level analysis, but you really need to speak to your CPA. So let's take in my $10 million sale. Let me say the basis in that, the adjusted basis in what I'm selling is $1 million. So if I sold the property and I did not do a 1031, I would have 9 million of gain, 10 minus 1, right? Yes, okay. So 9 million of gain. Now I do a 1031 and I put 5 million into the 1031, but I have 5 million or 2 million or whatever I leave out. Let's say it's 5 million I leave out, put in my pocket. I'm going to pay tax on that 5 million, but it's better than paying tax on 9 million, which is what would have happened if I did a no 1031 and just liquidated, because my basis is so low. Okay, let's switch the facts. Let's say my basis is 6 million. So if I sold the property, I'd have 4 million of gain. And the client says, Pamela, I want to put 5 million in my pocket before I close or at closing. You're going to have 5 million of boot. You pay tax on your boot up to the full amount of your gain. So you're going to pay the same, you're going to pay tax on 4 million. You might as well just have liquidated. So that's the analysis we do when you come to me and say we want to do a partial exchange. I'm going to do that high-level analysis, then I'm going to push it back to your accountant because I want to make sure your accountant doesn't know anything I'm not aware of with respect to the basis or your tax situation. So it's very important to talk to your accountant. Okay. I am switching gears again. I am going to talk to you about what is known as the G6 restrictions on exchange proceeds, okay? In a 1031, the qualified intermediary is governed by certain rules on what they do with the money once it's in our 1031 account. We are required by law to limit the client's ability to receive, pledge, borrow, otherwise obtain the benefits of the money we're holding before the end of the exchange period, except in limited circumstances. So what does this mean? Well, first of all, when does the exchange period end? Typically, 180 calendar days after the closing of the sale of the relinquished property. provided that you identified within the 45 days and your tax return is not due or filed at an earlier date. If you don't identify, your exchange ends on day 45, midnight of the 45th day, you get your money back on 46. If you identify and you're in this period between identification and the 180, then your money is actually locked up in the exchange, in the fund, until the later end of your exchange period. And that will occur either when you buy everything you identified or the 180 days arises. Even if you didn't intend to buy everything, if you've got a little money left over and you've got more properties on your list, it's locked up until the end of the exchange period. The only time that restriction can be relieved, you get relief from that restriction, is if there has been the occurrence of material and substantial contingency that relates to the exchange, is provided for in writing, and is beyond the control of the taxpayer and any disqualified person other than the person obligated to transfer the replacement property. Well, what does this mean? It means something occurred, you couldn't control it, your lawyer couldn't control it, your CPA couldn't control it, your real estate broker couldn't control it. Okay, the seller is okay. If the seller was controlling it, then that's okay, because they're not a disqualified person. Well, let's give it a couple of examples. What if there's an earthquake? You identified one property and it now is no longer there. I would say that's a material and substantial contingency. How about another that's right current today, a fact and circumstance existing today, the coronavirus? Well, just because the coronavirus is here does not mean that's a material and substantial contingency. But if it causes the contract to go bad, the termination, the seller can't deliver, then, and you didn't identify anything else, then you've got a material and substantial contingency. So there's a couple different things. Multiple properties that you identify within the identification period. If you decide before the 45 days you don't want to go forward, you're going to revoke the ID completely, leave nothing on the list. Your money gets back to you on the 46th day. After the ID period is over, you are locked up until the end of the exchange period unless a material and substantial contingency arises. Those are the G6 restrictions. That is law. We cannot change those restrictions. So we're not being greedy or difficult when we say to you, we cannot return your funds until such and such a date. It's the law. We have some proposed new regs that came out this week. They're not a lot to talk about in this particular seminar. I want to hit a couple of highlights. First of all, what do? They're defining real property. Well, we know what real property is. Why do we care? Because in the Tax Cut and Jobs Act, they took out from 1031 personal property exchanges. So that made it more critical to make sure that what we're buying and selling is real property. So they're going to come out with some kind of definition. Brad is going to take this slide and the next slide. And Brad, I'm going to give you about 3 minutes. So if you can limit to that, I appreciate it.
Okay, great. Yes, we know that real property is land and improvements. The regulations go into defining what improvements are, inherently permanent structures, and then also structural components of inherently permanent structures. And they have lists in there that are helpful, and they also have some factors to consider. What's it going to cost to move? Will there be damage done to the property if it's removed? Those types of things. Was it intended to be permanent? Are there, if you have a structural component, the regulation have an example of a sculpture that's in a building, and they say the building was actually built to support the sculpture. It's going to be hard to get the sculpture out of there. It's an integral part of the building. So there are examples that deal with that. One interesting thing in the regs, that the proposed regs to think about is it says that options to acquire real property are real property. Yeah, I thought one of the most interesting aspects of the proposed regs was that they say that options to acquire real property are real property for 1031 purposes. And that I'd always been very concerned about options to acquire property, and it says or similar rights. So, maybe a purchase agreement can be real property and can be exchanged. And Pamela and I worked on a transaction a year or so ago where somebody had gone under contract to buy property. Before acquiring it, before acquiring the property, someone had made an offer to purchase it. So they closed on it and they were going to sell it. And we said that would qualify for 1031 purposes because there was actually the acquisition of the property. But now it's saying that the closing doesn't have to occur. You can simply sell the option. And any gain recognized on the sale of the option could potentially qualify for Section 1031 treatment.
Okay, so the other issue that comes up is that, and this has always been the case, by the way, 2 comments on what Brad said. First, Brad and I are probably going to have an entire presentation on this. We're going to discuss whether we wait for the final regs or not, but it's really interesting. Brad's got this topic down pat. But the one point I wanted to make is that we always had this issue when we were selling anything that had a personal property component. Example, hotel. And what I would always say to my sellers, exchangers, clients, is when I see the contract and we're selling a hotel for $60 million, and of course what we talk about is, you know, everything that's going along with that in a bill of sale. And I would say, well, have we determined the value of that? Are you taking that at cash at closing and not going into the exchange? And have you assessed what that's going to do tax-wise? And sometimes they hadn't thought about it, but many times they have. And what they generally determine is that, let's say we're selling for 60 and we allocate $4 million to the personal property, we will take that in our pocket at closing. And many times it doesn't result in a gain because they're basically selling the asset for its depreciated value because it doesn't have the same worth as the rest of the assets. So personal property, furniture, and fixtures is sold at book value and therefore, you know, no gain. But that's another area you're going to work with your CPA on. You've got to think about that if you're selling any type of property or purchasing any type of property that has a personal property component. And we also get these questions in connection with cost seg, but that's seminar for another day. So the proposed regs allow the QI. Now notice this, we're not allowed to do 1031 exchanges except for real property. So now we're holding $10 million of your money and you're buying some property, and let's say it's a small motel and we see personal property in the purchase contract and the whole value is 10 million. Now, are we allowed to disperse the money for this purchase when there's a personal property component? The regs provide, the proposed regs, that if in standard commercial transactions, the personal property is typically transferred together with the real property, and the aggregate fair market value of the incidental property is not greater than 15% of the aggregate of the entire, it doesn't violate the G6 restrictions. That's why I put this slide right after explaining the G6 restrictions, because you might ask me when we're in the middle of an exchange, Pamela, disperse my money to pay my environmental costs for the property of my new property. I'm going to tell you can't do that. And here's why. Again, the G6 restrictions prohibit us from releasing monies in an exchange except for the purchase of replacement property and exchange expenses. So exchange expenses first come up in a 1031 on the sale side of the relinquished property. Exchange expenses can be paid from proceeds without creating taxable boot. Exchange expenses are limited to transfer taxes, broker's commissions, legal fees, recording fees, QI fees, and title insurance fees on the replacement property. Any other fees are not, in the conservative view, exchange expenses. So if they're paid at closing of the sale out of the relinquished property proceeds, they will generate boot, taxable. Examples. Anytime, lawyers, you see a credit on a real estate sale contract that's a 1031 against the proceeds, that's boot. It should raise a red flag. You should look deeper. Do we want boot? Do we care? What is it for? If the boot is a result of real estate taxes, the client's probably going to say, we don't care, because we know it's boot, but real estate taxes are deductible, so it's a wash. But what if the credit is a result of security deposits that the client is holding and owes to the buyer? And instead of just paying it to the buyer, they're crediting against the purchase price, which is what we typically do in a 1030, in a real estate sale, not in a 1031, but in a standard real estate sale. That's not going to be deductible. Those are operating costs. And what if they have other costs that they want to pay, other operating costs they want to pay out of proceeds? It's all boot. and that's a problem. So typically speaking, if you want to avoid boot, anytime there's a credit on the sale of the relinquished property on the settlement statement, the seller has a couple of choices. Either you bring those funds to closing separately and fund them so it doesn't reduce the proceeds going to the QI, or two, you POC, pay outside of closing, to the buyer the total of that fund. So again, there's no credit. Now, if the credit is for a repair, then there's two schools of thought. Some think it doesn't generate boot, but the best and the easiest and the safest is just to reduce the purchase price so that you don't have a boot issue. I have 4 questions. I'll take them in 1 minute. The next point I want to make on this particular slide before moving on is this same issue arises when you go to buy your replacement property. So let's say I'm selling for $10 million and I had $5 million of debt on my sale, so I paid it off on the closing of the relinquished property. I've got $5 million in a QI account. I'm buying for $10 million. Right? I'm getting a $5 million mortgage. Well, along with that mortgage comes all kinds of lender-related fees, including possibly and likely reserves. Well, reserves are for the future maintenance operation of the property. That is not replacement property. Using money for those fees will constitute boot if you get audited. So again, recommended practice, one of the best practices we recommend is simply to add up all of the fees that you would typically see as lender fees on a replacement property contract, and either have the seller, in this case it's going to be the buyer, the seller is now the exchanger, buyer, bring it to closing and separately fund it, and indicate on the settlement statement it's separately funded, so nobody can take the position it came out of your 1031 equity, or have the loan grossed up to cover, and again, make a mention that the loan has been grossed up and the gross up is covering these non-exchange expenses. There, again, I have to recommend, again, you always see your CPA. Okay, mortgage recording tax is a lender-related fee. So again, that would be not an exchange expense. It would not be an exchange expense. Okay, so our next topic, and I'm going to turn it over to Brad shortly, is how we use 1031 and 121 together. So 1031 is when we sell investment real property. 121 is when we sell our principal residence. How can we use these two statutes together? Well, I've got a couple slides, but I'm going to summarize in a couple of minutes because it's not such a complicated concept to understand. You do have to get your accountant involved to actually put it to work. So the first way that you have to use 1031 and 121 together is if you are selling a real piece of real property, part of its business or investment, part of its primary. So that can be a duplex where you rent one side and live in one side, a brownstone where you rent 8 units and live in one. Doesn't matter. You can have a lot of different variations on this theme. It can be rental or business use. So if you could have a property in the city where your business is downstairs, maybe you're an investment advisor and that's your storefront and that's where you conduct your business, and above you live. So that is eligible for split treatment. Now your tax advisor must allocate the portion used for business or investment, which can qualify for deferral. Any reasonable basis is typically sufficient. You could even use square footage unless there was a reason why square footage really skewed the value. In other words, if the property has much more value on the first floor than the second, square footage is not likely going to pass muster. But if you have been allocating on your tax returns this property correctly, you will have a track record of the portion of the expenses you have been deducting and the portion of the property that's been depreciated. And using that percentage is generally a good way to proceed. Now, any questions about how you allocate and so forth should, of course, be directed to your CPA, but there's a revenue procedure that has excellent guidance. It's probably one of the best revenue procedures I've seen, and it's Revenue Procedure 2005-14. So you can also look there. Here's a depiction of how this might look if you had 3 rentals and 1 primary. And another way to use this is to convert your residence into a rental. So What am I saying? Well, a lot of the folks in the Northeast have a primary residence where if they sell it, their gain is going to far exceed their primary residence exemption of 250 or 500. Let's say they're going to sell it for 3 million. Let's say their basis is like nothing and they've lived in it forever, and they're going to end up with $2.5 million of tax liability or capital gain and liability on that. So there's going to be a huge amount of capital gain. What can that person do? That person can simply, if they can, not so simply, move out, rent the property for a year, preferably 2, converting it to 1031, establish a new principal residence, and then within couple of years, sell what was the primary residence and do a 1031. In my example, in that case, if we do that and we sell it for 3 million, and 2 of the last 5 years it's been your primary residence, you don't lose that just because it's not your primary residence now. It has to be 1031 property at closing to qualify for 1031. But to qualify for 121, it only has to be your primary 2 of the last 5. So at closing, you get 3 million in, 500,000 if you're married finally jointly would go into the exchanger's pocket. They would owe no tax because that's the allocation for their primary residence portion, and they would put 2.5 million into a 1031. Now, I want to mention something here, one more provision. There's one more way this works when we convert a rental into a residence. So let's say we bought 1031 property as when it was residential, and now we want to change it over to our primary residence. My recommendation is always to wait at least 2 years before converting any investment 1031 property to primary use or personal enjoyment use. And let's say that time period has passed. Now let's say you convert it. Well, you need to be very much aware that after you convert it and then you're using it as your primary residence, if you sell it as your primary residence, you are not going to get your full exclusion ever again, because originally it was 1031 property. Okay, so you're never going to get the full exclusion again. It's going to be reduced by a ratio of the time the property was used as a principal residence compared to the time the property was used or rent in a business or rented. So the longer you've occupied it as your primary, the more of your exclusion you're getting. In addition, something to be very aware of is that you don't get any of your primary residence exclusion or exemption unless you've owned the property for 5 years. So you can't just live in it for 2. If you rented it for 2 and lived in it for 2 and then you sell it, you'll get none of your exemption because overall you did not own it for a total of 5 years. I want to mention the extension deadlines. First thing I'm going to say to you is this, that on April 9th, finally, the IRS gave extensions to the time period in which you have to identify and complete your 1031 exchange. They gave extensions. They were a little late because on March 13th, the emergency was declared. And there are some people that these extensions didn't help. But for those that had deadlines between April 1st and July 15th, they got an extension of that deadline to July 15th. So whether it was your 45 or your 180 days. Now this extension is pretty much moot at this point. Why? Because anybody closing now, their 45 days is after July 15th by far. So the only reason I'm mentioning that this exists today is there's 2 or 3. First, if you were a person that 45 days was running between April 1st and July 15th, and maybe you identified on April 2nd, these rules weren't enacted to the 9th. You have the ability, if you wanted, maybe you don't like what you identified, you were doing it in a mass rush, it was all kinds of pressure, we were in a very bad situation, and maybe you don't like what you identified. Well, you can revoke that identification and re-identify as long as you get it in by July 15th. There's a formal process to revocation. Also, those who are having trouble closing on their sales, or their purchases, depending on whether we're doing a reverse or a forward exchange, you have to July 15th. So that should alleviate a lot of the stress. So if you're in a reverse exchange and we're parking your replacement property and you haven't been able to close on the sale of the relinquished, as long as you can get it done like by July 14th, you're going to be okay. After that standpoint, then you have to look to see if your tax advisor believes that there's a separate provision of the code that allows 120 days to extension on any timeline where there is an IRS disaster relief notice. And I know Brad believes that this 120 can help some people. So if you are in a situation where July 15th is coming and you have not identified or closed, so it's not enough time for you, you should reach out to a tax advisor, and I'm sure Brad would be happy to help, and see if you possibly can benefit from the 120-day deadline extension. The reason we at API don't believe it applies is because the notice did not make reference to Section 17 of Rev Prop 2018-58. I think there's certain authorities that believe that doesn't matter because that separate provision states that the extension is granted to whichever is later. Either the deadline's put in the notice, which in this case was July 15th, or 120 days. We're conservative at API, but that doesn't mean all is lost if you're coming up against that July 15th deadline and haven't been able to sell or whatever else it is that you need to do.
So one thing about the extensions is we probably want to wait and see. I was talking to someone at the IRS last week about a question about something I had written, and we were talking about something else I didn't ask. Are they providing guidance, or are they going to grant use the 120 days? But the impression I got is this is going to be relief, and I wouldn't be surprised to see if the IRS comes out with some guidance that says it's 120 days, not July 15. And I think they recognize they need to get that done soon.
Yes, like in the next 3 weeks.
Yeah, I know. So we'll see. Hopefully we see that soon.
Okay. Now, do you have the screen?
I do.
Go ahead.
Situation. Yeah. So I think we'll spend a little bit of time talking about scope of the engagement. Pamela just spent a lot of time talking about a lot of the technical issues that come up with Section 1031. And the question is the attorney taking on all of those responsibilities when an attorney signs up to help with a real estate closing? And most of what we talked about was on the sell side. And I've been, so just a little bit of background. I'm a professor, tenured professor at Brooklyn Law School, but I also do a lot with Section 1031. I advise clients with respect to the tax planning and structuring side of it. I've served as expert witness on numerous cases, some of them malpractice, some of them other types of cases. In the malpractice cases, one thing that we've seen is, you have real estate attorneys that are hired to help with the real estate part of it. And then you have things that come up. One of the things that came up back in the 2008 related to the financial crisis, we had Section 1031 QIs that failed. Money was held by the QI. It wasn't available to use to acquire replacement property. It took a while to have the money distributed. 1031 non-recognition was lost. And then some of the proceeds, I think the proceeds were ultimately distributed. At least most of them were distributed. And in some cases, there were additional proceeds distributed to help compensate for the lost tax benefit. But that wasn't known at the time. But what we saw was some exchangers brought malpractice suits against attorneys, and the claim was that the attorney didn't tell them about certain aspects of qualified intermediaries, or and then the defense was, well, it was beyond the scope of the engagement. As a real estate attorney, I was hired to do the real estate closing, and this raises issues related to our duty as attorneys, but also it relates to ethical issues. So what obligations does an attorney have with respect to Section 1031? If you're making the defense that the scope of the engagement was just to do the real estate closing, but you put on your invoice, there's an entry there that says reviewed the Section 1031 documents or reviewed the exchange documents, that may go against the argument that the scope was limited to the real estate work. And a lot of times we'll see in the PSA, there will be a cooperation provision that says that the buyer and the seller will cooperate if either party is doing a Section 1031 exchange. If that's in the form document, do we then have an obligation as the attorney to talk to the client and tell the client that Section 1031 is available? I'm sure that Pamela's had numerous calls where the sellers at closing Maybe the buyer is doing a Section 1031 exchange, and the seller learns about it and says, "Oh, I want to do a 1031 exchange." And so at that point, they try to do a last minute, set it up last minute as a Section 1031 exchange. I'm not sure what your reaction is when you get that call, Pamela. I know that QIs will do everything they can to accommodate, but that's pretty short notice.
We just tell them, give us 30 minutes and they'll have the documents. We're glad to have the business. So we don't worry about that so much. Should I go to the next one?
Yeah, we can go to the next one. So yeah, that happens, and the QI's there to facilitate it. Obviously, the attorney at closing, if you get the documents in 30 minutes, does the attorney have time to review the documents if they haven't thought about telling the client about Section 1031? They may not be familiar with Section 1031 and may not be familiar enough to adequately review the docs, but the QI will do everything in its power to get the documents out and ready. So the rules about limiting the scope, as attorneys, we can limit the scope of our representation. So that's the rule 1.2. We're talking about New York rules of ethics. The comment says that the lawyer must adequately disclose the limitation on the scope of the engagement and the matters that will be excluded. So this sounds like there's an obligation to not just say, I'm being hired and I will represent you and help you with the closing, but if you don't want to do the tax work, specifically provide and exclude tax advice.
And I have a lot of clients that use, a tax attorney along with your real estate attorney. You're covered.
Yeah, absolutely. It's a very good idea. Disclose the reasonably foreseeable consequence of the limitation. So this is if you're going to limit and say, I'm not going to provide tax advice, then you might also want to recommend or say that, this transaction does raise tax issues. You probably want to find separate tax counsel. And of course, I think that Pamela, part of the point you're raising is if you're a real estate attorney, you don't have in-house tax, then the question is, where do you go to find that? Because a lot of times there's concern that if you go to a general, a full service law firm, that they're going to take the real estate work as well. So there are attorneys out there that do exclusively tax work and are take special care to ensure that the relationship between the real estate attorney and the client is respected, and there's no effort to take that real estate work and provide exclusively tax work. So here's some sample. What was the prior slide, Pamela? I think there was something. Okay, yeah, this is just a case that it relates to the comment that the attorney has the obligation to limit the scope and to show that the scope was limited. Okay, that's in a malpractice suit. I guess, yeah, and here's just some sample language. Broad scope, we have been engaged to represent you in the disposition of real estate located at whatever. Here, there is no language excluding the, providing tax advice. In the next one, it says that the representation is limited. The engagement will provide services with respect to negotiating terms, drafting required documents, and closing on the disposition of the property located at whatever. And the question here again, it doesn't exclude the provision of tax advice. The last one, there's an express exclusion. So if you want to make sure that you're limiting the scope, this is the safest way to do that. The representation does not include advice or services regarding accounting or tax. And that's the safest if you want to limit the scope. There's a case out here where there was a failure to limit the scope. And again, these are talking about malpractice cases. Here, the law firm said, I think it's the last sentence there, in addition, we will represent you in negotiations with your landlord or successor landlord. So the attorney is being hired to help with a dispute. There was a lease, and the lease term was expiring. There was an option. And so here the tenant is trying to negotiate a buyout, and the attorney is helping with the negotiation of the buyout, but failed to exercise or tell the client needed to exercise the option. So the client didn't exercise the option, the failure to exercise the option, the lease terminated, and there goes the leverage for the negotiating the buyout. So the court said that representing the plaintiff in negotiations with the landlord arguably can be interpreted to include exercising plaintiff's renewal option under the lease. So the attorney did have an obligation to help with that renewal option. So we can limit the scope, but just be sure if you want to limit the scope that you do. All right. So this is actually a pretty big issue that comes up in Section 1031 exchanges. What responsibility does the attorney have with respect to representing a client and identifying, selecting a qualified intermediary and ensuring that the proceeds held by the qualified intermediary are safe? And I think we had updated this. There's a different safe harbor choices. We may be using an older version of these slides, Pamela, so you have qualified intermediary is the safe harbor that everyone uses, and the question is, do we add other layers of safety to the qualified intermediary? And the bullet point that's missing here is the qualified intermediary. There are different qualified intermediaries take different measures to secure or ensure the security of exchange proceeds. And one thing that you definitely want to see with the qualified intermediaries is a qualified intermediary using segregated accounts. And it may be the best thing to do, maybe to let Pamela talk a little bit about what that means.
Sure. Okay. So, I mean, just in brief, a qualified intermediary account that is segregated, which is all we use, means that your money is going into an account that belongs to the exchanger, your client alone. It's not commingled with our operating account, nor is it commingled with other 1031 exchangers funds. I don't, God forbid, that you've got a QI that's commingling funds with their operating accounts. That I hopefully never will see. But there are many that actually just have a QI account and everybody's funds go into the QI account. It's not segregated. Now, that's not the end of the world. It's just not best practice. And I think that your client will want to see a qualified intermediary segregated account. And Brad, then you can talk about the other safe harbors.
Okay. Yeah. And the reason this comes up, and maybe just go back to a little bit of history here. With the financial crisis, there were a few high-profile QI failures, and what the QIs had done is they said, "Okay, we have this float. The amount of exchange proceeds we hold never goes below a certain limit." And just to use a random number, maybe they noticed that over the last 5 years they never gone below $100 million with the exchange proceeds they held. And so they said, "Oh, we have this money. Let's do something with it. Let's find a place to invest it that's secure, but then provides a better return than just a deposit with a bank." And so we had Land America Exchange Services was a QI. It was owned by Land America, which was the third largest title company in the country. And that QI, Land America Exchange Services, decided to invest the float in auction rate securities. And it was student loan debt, and everything was fine. They were getting a nice return. But then what happened is when the financial crisis hit, there were fewer real estate deals going on. So there were fewer exchanges happening. That means less money was coming in. And so they started to go below the $100 million. They started to cut into the float. And when they went to sell those auction rate securities, the market had become illiquid. And because the market was illiquid, the cash wasn't there. And so they weren't able to meet the obligation to distribute exchange proceeds. And they declared bankruptcy. I think it was right before Thanksgiving in 2008, they filed for bankruptcy. And there were I think 450, see if I have the numbers right here. Easy to get to. With Land America, so Land America, it had 530 exchanges. Now it had 450 exchanges that it was facilitating. Of those 450 exchanges, 4 of the exchangers had put the money into a qualified escrow account. And so the question became, does the money that's in the qualified escrow account belong to the QI bankruptcy estate, or is it outside the QI bankruptcy estate? One of the big exchangers settled and got 98, I think it was 98% of the money held by the qualified escrow account was distributed within a few weeks after or maybe it was a few months after the bankruptcy declaration. Some of the other exchangers who had money in the qualified escrow account, they held out and fought a little bit harder, and they got 100% of the proceeds held in the QEA. I don't know if there was ever a ruling that said that the money held in the qualified escrow account was outside the bankruptcy estate, but the fact that they were being settled for such high amounts and then distributions suggests that at least that trustee was outside the estate. Go ahead.
So yes, and so there's one state in the nation that provides that funds held in a QI account are held in trust, and that's California. So when I get off this call, I'm going to be on an hour call because we've also just revised our exchange documents, which is something we do very often. But that provision that California law is controlling has been in there forever since I started with the company, because of exactly this. One of the issues, I believe, Brad, that came up in Land America was, were these monies held in trust? And the documents, I believe, and I'd rather not comment, but I think they were not as well drafted as may have been, and there may have been other ways to protect those funds and keep them from the general creditors. So what we do at API is we offer what we consider to be layers of security. Of course, the QI segregated account, the other types of accounts, the backing of our parent company, but also the very careful drafting of the exchange documents to ensure that if there's a nationwide calamity and everybody is in trouble, that the money is available and declared to be the exchangers and not that of our general creditors or anybody else's. And so, there are different things that can be done and options. And so, I think, Brad, you're making the point that someone should investigate those options when they're selecting a qualified intermediary.
Right. Yeah, and some of these malpractice suits, the claim was, well, I didn't know that there was a qualified escrow account. Why were there 4 exchangers in QEAs and I wasn't? And so the client is making the claim that the attorney should have let them know about these different options.
Right.
So,
and we don't often get asked, but those options are there. The QI account comes with our parent backing. It's always offered. But you're right, that question doesn't often get asked. When it does get asked, then you go through options that are available. Another important factor is that where are the funds going? In other words, who's the depository? At any one time, we probably have 4, maybe 5 depositories that an exchanger can select from, and they can't select from just anybody willy-nilly, because we have to do very stringent safety and security checks on the depositories, or we will not put funds there at all. So, we offer a list, and an exchanger can select the depository where the funds is ultimately going.
And then there's a potential responsibility. We'll talk a little bit about. Again, we can limit the responsibility with the scope, saying we're not going to advise with respect to QIs. And then another issue is, are we as attorneys making the referrals? And there are a few things going on here. How well do we know the QI? And then, part of the referrals is, we're attorneys. Our obligation is to the client. We know that if we have a relationship with a QI, then we make referrals or maybe referrals back. We want to maintain those relationships, and then we just have to ask whether that creates a conflict and how we deal with that. And we'll talk a little bit more about QIs that push the envelope and what our responsibilities are there. Why don't we go on to the next slide and see what it says? So this is saying that as an advisor, this is actually in the comment, but it says, in rendering advice, a lawyer may refer not only to the law, but to other considerations such as moral, economic, social, psychological, and political factors that may be relevant to the client's situation. So we may be asked, and the client may expect us to talk about issues related to the QI and the QI's ability to serve as a QI and the safety of the proceeds. And it may be, extend beyond just offering legal advice. And we need to be careful if we're going to do that we identify the scope. And if we want to couch our advice in terms of narrow legal terms, that we may be able to do that, but it may be of little value to the client, especially where we know that the client doesn't necessarily have the skills or the competency to deal with just technical legal advice. And so the technical legal advice may be inadequate, and these issues are issues that we may need to know about as attorneys. If it's something that's beyond our scope of expertise, then we may need to tell the client, we can't do that, and they need to see someone else. Like, I don't know who we're going to talk to about the financial health of a QI. There's really no one out there that knows that better than the attorneys, because to some extent we can't know. That QIs don't provide audited financial statements. We don't have anything that says that they're actually doing what they say they do. We do have history. We do have, our experience in the past, which may or may not be an indication of what's going on in the future. I think Latin America had held out that it was secure financially until the day that it filed for bankruptcy. So we may not.
Brad, on that comment, and you're right, it really is the client that has to figure it out, but we offer each client a letter of backing from personal to the client from our 125-year-old parent who's publicly traded. Their financials are totally available on their website at any time. So there is transparency in that respect, so that, you can actually see what's the financial status of this entity.
Very good. Yep. And that's something that, we may not, as attorneys, we may not be able to, we're qualified to comment on. Correct. That letter, but yeah, negligent referral. So the other thing is, if the client comes to us and doesn't have a QI, again, if we're going to be referring QIs, there are cases out there where, parties have claimed negligent referral. This case is saying that, again, this is one that's actually coming from, it's a New York ethics opinion, but it's saying that, this is the whole issue of negligent referral is maybe not an ethical question, but I guess this would be dicta. The highlighted provision says providing several names gives the prospective client more information to make an informed decision, and arguably avoids the inference that the lawyer has steered the prospective client to a particular lawyer. So the same could be true with QIs. Maybe one thing to do is to provide more than one name. If you're aware that a QI is having problems or doesn't follow some of the rules that we're going to be talking about, maybe it is fast and loose with the G6 restrictions, maybe turns the other cheek or helps, or turns a blind eye, I should say, or helps the client engage in fraudulent or questionable identification practices, you probably don't want to put that QI in the list that you're referring. And so I think if we go on, Pamela, I think some of these issues come up in some of the next slides. Yeah, so here it is. This is a QI that's a little bit shady. The QI is saying in a call, so you're with the client. The client may have chosen this QI, which raises some issues here, or maybe this is a QI that you're familiar with. But the QI informs the client that it will distribute the client's exchange proceeds to the client at any time upon written request from the client. And Pamela had gone over the G6 restrictions earlier, saying that during the 45-day identification period, the QI cannot distribute the exchange proceeds. It's in the document, it's in the safe harbor, cannot distribute the exchange proceeds during the 45-day identification period. After that, if the exchanger had identified real property, exchange proceeds cannot be distributed until all the identified replacement property has been acquired, or the end of the exchange period, the 180 days or the tax return due date. So this QI is saying, we're not going to really abide by the G6 restrictions. And this is problematic for a couple of reasons. First of all, if you're an exchanger and you say, okay, I decide I don't want to finish my 1031 exchange, I'm going to receive the cash, I'm going to recognize the gain. This is a decision that the exchanger can make. That's fine with respect to that given exchanger. It may say, I understand we've entered into an agreement. You're going to hold my proceeds. You are not going to distribute them. I now want them. I'm going to recognize the gain. And so there's really no harm to that exchanger in receiving the early distribution. The problem is the regulations say that those funds held by the QI must be the taxpayer's right to receive pledge, borrow, otherwise obtain the benefit of those exchange proceeds must be restricted. If the QI makes a distribution, then that language in the exchange agreement is illusory. And not only is it bad for the person to whom the distributions are made, but those G6 restrictions probably don't apply to any exchanger. And so the QI really isn't a QI. And so that's a problem. I think if we go on to the next slide, it'll talk a little bit about some of the ethical issues here. So here there's a potential conflict of interest. A lawyer shall not represent a client if a reasonable lawyer would conclude that either, and we're going down to this, is going to be a conflict between the attorney and the client. What's in the client's best interest versus what's in the attorney's financial, business, property, or other personal interest. So if this is a QI that the attorney works with, the attorney knows that this is an issue, and it can potentially harm the client, then there's a conflict of interest between the attorney and the client. And the attorney needs to inform the client that the QI plays this way, and that it probably is going to affect the, if that situation was ever audited, that QI was ever audited, then the IRS could come back in and say, oh, you're making distributions early for some clients. The language in your exchange documents is illusory. All of your clients failed to qualify for Section 1031 treatment. That's a problem. So you definitely, even if this is a QI that you know and that you've worked with in the past, if you know this is going on, you have an obligation to let the client know. And it may affect your relationship with the QI, but the rules of ethics require that we put the client's interest first. The same thing here. Here's the identification. There's a QI that's playing games with the identification rules. Maybe it says, send me the identification form. And it says that the form, so the QI forms generally say, identify the property, and they give space to identify the property. Either the 3 property rule, the 200% rule. So in that space is provided, you just put see attachment A, or see the attachment where the property is identified. So you submit the form signed within a 45-day period, and the idea is you'll send the attachment in after the 45-day period expires. That doesn't work. For the property to be identified, it has to be specifically identified before the end of that 45-day period. So if the attachment's not there at the end of the 45th day, that's a problem. What ethical obligations do we have? Is there any leeway with the 45-day identification period? The answer is no, unless there's been a disaster and there's been specific extensions of time. Otherwise, it doesn't matter if it's Saturday, it doesn't matter if it's Sunday, it doesn't matter if it's a holiday, it doesn't matter if it's a birthday. The 45-day identification period ends on the 45-day identification period. No leeway, no grace period, unless there's a disaster. So does the QI's recommended approach work? No, it doesn't work. So what do we do as an attorney if we know this is going on? Can we help the client? Can we, if we go on, go on to the next slide. We know that there are people out there, we're talking about this because there are QIs out there who are known as accommodating accommodators. And people know that they'll play with the rules. But this is, again, going back to the scope of the representation. We said we can limit the scope. Here the rules of ethics actually limit the scope of what we can do. A lawyer shall not counsel a client to engage or assist a client in conduct that the lawyer knows is illegal or fraudulent, except that a lawyer may discuss the legal consequences of any proposed course of conduct with a client. So I guess we can say this is a fake identification or backdating identification document or any of that stuff is fraudulent. And we have a case out there. I think we go to the next slide. It talks about that case. The taxpayer backdated identification form. So Section 1031 treatment was disallowed. The client was treated as having received the funds held by the qualified intermediary, and the taxpayer here was liable for additions for civil tax fraud. So messing around with the identification form, we have a court here that says it's fraudulent. So we're assisting in fraud if we're doing this, and the rules specifically prohibit it. You can tell the client, if you do that, I guess we're not assisting. If you do that, then you're going to be, these are the potential consequences. If you get caught, this is what happens. So I guess we can tell a client that. We can't then help them. Okay, so this is going back to the timing issue. We have to know these rules. It's conservative to wait 2 years, but what if there's a deal? A 1031 exchange was just completed, and now the client calls and says, "Oh, I just got a call from a developer. They want this property. They suggest that we put it into an LLC and develop it." Do we have to wait 2 years? Do we have to wait 1 year? Here's the situation. So 2 years is good because it shows that we didn't have an intent at the time of acquisition. And I think that, Pamela talked about this with respect to the, personal property. If you buy a residence, you buy a residence and then you buy it with exchange proceeds. Now you want to convert it to your principal residence. You want to live in it. If you live in it within a couple of months, then it suggests that, oh, you bought that with the intent to live in it. If you hold it for 2 years, it looks like maybe you didn't buy it with the intent to live in it. But things can happen, right? You can have, let's say that you live in New York City, you bought a property in Nashville, Tennessee. I'm not sure why you would do this, but it was one that you were it's a residential and you were just going to lease it. It's a college town. You knew that there's always going to be interest in that property as rental property. But then coronavirus happened. And now you're saying, I'm not sure I want to live in New York. I don't know if I'm ever going to ride the subway again. I'm afraid to do that. So you say, I'm leaving New York and I'm going to move to Nashville and I have a house I can live in. And you bought that house in December. You were doing renovations. You were getting it ready and you actually put it on the market to lease and you were getting ready to lease it in March. And then all of this happened. So you have this intervening event, right? You've owned it now for 5 or 6 months and now you move into it as a principal residence. Does that affect your purpose in buying it? Well, you can show that intervening events happen and you're actually really working to make it investment property. And the same thing can happen here. This person acquired the property. Maybe this was in Tennessee, outside of Nashville. And people are leaving the big cities and they're moving to smaller towns. And so now all of a sudden, property that you had bought and you plan to hold long-term is now prime for development. And you can show that these things happen. So within 2 years, the client wants to make the contribution. And what are our ethical responsibilities here? Is there a holding period requirement? I don't know what about putting it into a TIC, developing as a TIC? That raises issues. If you're trying to do it, if you're trying to develop property as a TIC, that becomes really complicated. Starts to maybe look like a partnership. Can we do development activity? There's case law that says yes. Let's see what the ethical issues are here. Down if we move on. So I think we just have to know the rules. Okay, it's good to have, the longer we wait, the better. But here we just have to know what's going on and know if we tell a client, no, there's an absolute 2-year holding period requirement, we didn't know the rule. And then we shouldn't handle a legal matter that we know or should know that we're not competent to handle. And this goes back to the scope. If you're going to keep the scope broad, then we have to know all of these issues, right? We have to know that if we're going to do a partnership division, we have to know all the rules about partnership distributions. How is debt relief affecting that?
And I want to mention one thing, Brad. There's a balance here. So I have clients that come to me and say, I'd like to do a 1031. I'm working with my regular real estate attorney. He or she is not an expert in 1031s. Do I need to get a different attorney? And my response to that is that we are able, as the qualified intermediary, to guide the lawyer through the 1031 requirements and explain to the lawyer what those requirements are. And also, if they get into an area that's gray, such as the holding period, give them the current law and authority on the issue. And that's where we stop. We can't give advice past that. So then the lawyer would take that information and probably information from the CPA and apply it to the client's facts and circumstances and provide the legal advice. So my answer to the folks that say, do I need a lawyer that does only or is expert in 1031s is no, that we can provide the general guidance on the 180, the 45, what's real property and things like that. But the lawyer will still need to be the one providing the legal advice.
Yeah. And I think that the way you would phrase it is the client says, do I need another attorney or can I use this attorney? And the answer is you can definitely use, I mean, an attorney who doesn't know 1031 can definitely do the real estate part. There are enough people out there where you can, the client can get the 1031 advice either from a CPA or a tax attorney, or if there's enough information that QI can provide the attorney, then that works as well. I just don't want to put the QI on the spot. That the QI saying I don't provide legal advice, then yeah, then you got to figure that they need to find, that the client may need to get tax advice. And a lot of these transactions are so small.
Or don't have, gray areas. Even the large ones are straightforward or don't have, but the minute you have an issue that I believe is not clear cut, I'm going to be telling you in the email, in the phone call, to seek legal and tax advice. And if you need an advisor, I'm going to be providing you with resources to get the proper advice, because, too much at risk.
Right. And so even with simple exchanges, I mean, I've
The
been
hardest.
asked, what's that?
Sometimes they're the hardest.
Exactly. And I've been asked, it was if you start getting into transactions that are, how many did 100 million? Is that 9 figure and above? Sometimes it's simple. It's just a sale. It's going to be an acquisition. And they say, I just want an extra set of eyes to look at it. And you get into issues that you talked about where, I mean, here the prorations and different expenses at closing, they get to be pretty big. And so you were talking about, you can pay the prorated rent or the prorated taxes, and that's deductible. So if you have boot, the deduction offsets it. But some of these people say, well, I would prefer to use the deduction to offset other income and avoid boot. Right. So some taxpayers are saying the numbers are big enough here. We're just going to hire somebody, and we're going to have somebody, extra set of eyes look at it. And a lot of times,
He recommended.
Yeah. And a lot of times what happens, I did that with one exchange recently, and then the acquisition ended up being a little bit complicated because they were buying a share of property that was held in a different entity, and some of the owners were related to the exchanger. And so there are ways to structure that to make it work and to avoid the related party rules and to do it simply.
If there's no intervening event like COVID, does the lawyer have to review facts and circumstances to determine the intent of the exchanger at the time of the exchange? Or can the lawyer rely on the client saying it's investment property? That's a very good question. And you're going to get that both on the sale of the relinquished. One of the things that we do when you call us is I'm going to qualify the deal. So I'm going to be asking, if I'm speaking to the client, I'm asking, what is this property? Where is it located? What do you do with it? How long have you owned it? If I see personal enjoyment in there, I'm going to be telling the client a lot of things and emailing a lot of information so that they can, with their advisors, make sure this is qualified. But Brad, this is a question for you. Does the lawyer have the responsibility to determine that the property, either it's relinquished or replacement, is investment and going to satisfy pass muster?
Right. And this, we should add circular 230 to our presentation at some point. But there are rules in circular 230, and they apply to people who are providing tax advice, return preparers. They can be broad enough to include any of us that provide tax advice, even if we're not preparing a return. But in there it says, we don't have an obligation. We can rely upon representations made by a client if we don't have reason to believe that it's wrong, or if we don't know that it's wrong. So if a client is just telling you, my intent when I purchased that, you have to think about how it came up. If you were representing a client on the acquisition of that property in Nashville, we talked about the residential property. At the time it was closing, the intent was to rent it, and you may be done at that point. If the client comes back, if the client just moves in 6 months later, you may not even know about it, right? So I guess if the client calls you and says, I bought this property 6 months ago, I want to move into it, does it affect my 1031 exchange? I don't know that you've completed your responsibility as an attorney by saying, was your intent to acquire it for investment? And the client says yes, you can just say, okay, you can move into it. But I think the client is asking, can I move into the property now without affecting my 1031 exchange? you need to have more facts to be able to tell the client yes or no.
Yes, and in this presentation, we didn't talk about it because there's too much to talk about, but, and Brad's absolutely right, you need more facts, because there are some cases, and don't rely on these and don't mimic them, where the client has moved into a residential property and converted it. But Brad points out that, you know, in one case they lost, bad facts, another case they won because they had good facts. Economic hardship resulted in their need to move into the replacement property and make it their primary, which did that economic hardship did not exist when they bought the property. And of course, as Brad points out, there were other good facts. They tried to rent it and so forth.
We're getting a little bit short on time. Yeah, then this is just going into what we had talked about here. Why don't we go down and see what? So here you have someone that bought a condo for personal use for $2 million. There's an offer for 2.75. You know, what ethical obligations attorney have here? We have Section 121, which excludes $500,000 for married couples, $250,000 for single. So we can't exclude all of this gain under Section 121. And is there any way to bring this into Section 1031? So we just talked about this. We have to know here the legal issues. Pamela talked about you can combine 1031 and Section 121. And there are rules about if you lived in it, if you rented it and then move into it, can you then exclude you exchange into property, you then convert it to personal use, can you now exclude the pre-exchange gain? And so there are rules to talk about in Section 121. There's the Revenue Ruling 2004. What is it again?
5-14, Rev Prop 2005-14.
Yeah, very good. 2005-14 that talks about mixed use. You need to look at those. And then again, if either we have to get familiar with those rules or we have to say no. We can probably also add to that, you know, what level of knowledge do we need to have? Can we rely upon client representation? Do we need to ask if the client says, oh, this is rental property, it's a condo, do we need to do more? Or do we need to ask more? What if it's a co-op? If it's a co-op that a client is selling and say, no, it's rental property. We know that co-ops can be different from condos. The lease may provide, or that the owner has to occupy it, and if the owner has to occupy it, and so if we know that a client is buying a co-op, that tells us that it's time to end.
Yes.
But yeah.
So if it's a co-op and the co-op restricts rental, you got an issue.
Right.
And in the co-op provisions, right? So you can have an issue.
That's on the acquisition side, right? If someone's buying a co-op, automatically we have to ask. We need to see that. We need to see the documents if there's a restriction on you occupying it or leasing it.
In addition, I wanted to say a special thank you to Brad for giving us his time. I want to thank everybody for joining us today. And thank you all very much, Brad. Thank you very much. One more thing I want to say, Brad's contact information, which as you can see is pretty darn valuable, is at the end of the presentation. And so when I send you the handout, you'll see all of his contact information right there. Brad is an invaluable resource to me every day. Thanks everyone very much again.
Thank you, Pamela.